Okay, hello everyone and welcome to the third East Capital Outlook seminar for 2024, when we'll be focusing on emerging markets. My name is David Nicholls. I'm a portfolio manager for the Global Emerging Market Strategy, and I'm here with my colleague Jacob Grapengiesser. And I'd like to just start with maybe something of an obvious question, but the question is sort of what are emerging markets? And if you look here on slide 2, you can see what the current weights are of the various countries. And obviously, they've changed quite significantly over the last few years, which is something we'll touch on a bit later. But I think one of the sort of misconceptions we wanted to address just from the start is that this idea that emerging markets are quite a homogenous asset class. Basically, all the countries and assets just move together, and that really couldn't be further from the truth. I think the most obvious example of this is that emerging markets returned 10% last year, but excluding China, they returned almost 21%, which was a fantastic year, not that far off developed markets, which returned 24%. But I think even if you take out China, which everyone knows is quite unique, it really is that every country and region in emerging markets have a very unique set of drivers. And that's what we're really going to try and unpack throughout this seminar as best as we can. But if we just take a step back to look quickly at the global top-down picture, and this is on slide 3, our view is that in theory, the backdrop for emerging markets should be slightly more benign and constructive really in 2024. We're no longer talking or as concerned about a hard landing in the US, and instead of sort of significant rate hikes, we're actually talking about rate cuts. And of course, that should be very positive for emerging markets, given it'll lead to lower discount rates, cheaper debt, and of course, likely a weakening US dollar. And if we look at what the market's pricing in at the moment, it's pricing in almost 2 percentage points of rate cuts, which will obviously be absolutely fantastic for the asset class as a whole. But as you can see by these grey lines, which is what sort of market pricing, market does tend to get a bit ahead of itself with pricing in these cuts. So I think we would be a bit cautious here before going all out. And then if we move on to slide 4, I think the other sort of big question for 2024, as well as the rate cuts, is really how the global economy will deal with these high rates, which of course have very profound impacts on both companies and consumers across the world. And if you look at the latest forecast, these are from World Bank, published last week, it's not going to be fantastic, right? I think particularly in developed markets where growth is expected to fall from 1.5% to 1.2%. Emerging markets, however, holding up a lot better, just at 3.9% growth. And that's really consistent with our discussions with companies. They're not struggling with inflation or high rates or sort of weakening consumer sentiment anywhere near to the same extent as developed markets. And this is a key reason why we think it does make sense to at least look at emerging markets from that point of view. But of course, what everyone is obviously very interested in is actually China, which it remains a pivotal country for emerging markets. So I'd like to hand over to Jacob now to discuss his China experience.
Thanks, David. I'm Jacob Grapengiesser, CIO of East Capital. I recently relocated myself and my family to China to be on the ground and see for myself what's actually going on. And if we just start with some pictures, what I've been up to in the past couple of months. So I've really been traveling all over China. If we start on the bottom left, this is a polysilicon factory in northern Tibet. I don't think many foreigners have been to this factory. It was just built for about $1 billion, and polysilicon is the raw material for solar panels, and we can see some of the solar panels just above that. But it's really been everything. To the right, we can see BYD, the world's largest EV producers. We went to their factory with a team. Above that, one of the world's largest crane manufacturers. To the further right bottom, this is a huge recycling company in China, and obviously that's a big business, right? And we are an Article 9 fund, so we want to be part of all these type of themes as well. But I think what everyone is talking about now is clearly the Taiwanese elections, right? So on Saturday we had elections in Taiwan, and the DPP, so the Democratic Progressive Party, they got 51 seats in the parliament, so they lost majority in the parliament. And this is the big change, right? So the president got 40% of the vote, It was 57% last time. And in the parliament, they got less seats than the opposition, which is the Kuomintang. What does this mean? It means that mainland China sees Taiwan slightly less united and slightly less united in terms of being pro-US. That decreases the likelihood of a conflict. And I think that's quite important. The Chinese market has been weak for many reasons. The economy was one of them. But I think most importantly and currently, it's about geopolitics. So I think in a couple of weeks' time, we will probably see that the geopolitical tensions hopefully have a little bit been toned down by international investors. Then you go back and you look at the fundamentals. And if you do that, you'll find a lot of interesting companies. So these elections have been clearly very important. If we move on to the Chinese economy, so recent GDP numbers were a little bit below expectations. Fourth quarter GDP came in at 5.2 versus 5.3 expected. These are obviously marginal differences. 5.2% for the full year is still a pretty good number. I think the problem is in China is not that it's not growing. The problem in China is that you have a deflationary environment. So you have a weakness, you have a consumer weakness. In December, year on year, there was a 0.3% deflation. Only a couple of months ago, we had inflation. In small inflation is actually positive because it means that the economy is doing quite well, right? Deflation means that the economy is doing not well. So this is what the government is, I think, preoccupied with. In order to resolve this, they don't have this big splash like you would do in the US, right? With just pumping a lot of money into the system. Instead, they do a lot of incremental measures. So if we look on the slide here, we can see that the yields have been coming down gradually in China. The 10-year bonds in China are at 2.5%. In US, it's 4%. And this is close to 20-year low in China. Mortgage rates have been coming down, and you have a lot of just small steps that the Chinese government is taking to prop up the economy. If we look on the trade surplus, well, actually, the trade surplus compared to pre-COVID has doubled. So China has turned from exporting, let's say, a lot of relatively cheap products to actually expensive and truly kind of value-added items like electric vehicles, solar panels, advanced machinery, etc. So yes, growth slightly below expectations, but for any investor, and I think any company, they just need to be invested in China. It's 1/3 of global growth. So if you look on the chart here, China is the red part, right? So US is going to be 10-15% of global growth. The EU only 5%, and then China 1/3. India is also relatively big, but China is really the dominant one. So even if Chinese growth is going to come down to maybe 4.5% in the next couple of years, it is still going to be 30-35% of global growth. Yeah, so I think on the stock market, they have been weak. China is down 3 years in a row. It was down around 11% last year and is continuing down this year, unfortunately. Again, I think it's all about the Taiwanese elections. And once we see that sort of settling down, I'm quite optimistic actually about the market. But it's difficult to time it. I'll be honest about that. So we just try to look at the companies, and there are 3 segments of the Chinese markets. You have the A shares, which are the local market. It's for mostly for the local investors. Foreign investors like ourselves can also participate. I don't think that companies on the A-share market are, as they say, a bargain. They are not that cheap. We're speaking about maybe P ratios of 15-20 and something 15-20% earnings growth. But if you look on the H-share market, which is the Hong Kong listed names, for example, you have Alibaba at 7 times earnings and an 8% dividend yield. This is sort of the big tech company of China, one of the two big tech companies of China, comparable to the big tech companies in the US. So, you know, to get that at 7 times earnings, I mean, that is obviously cheap. We actually today, for the first time, we bought a company called China Education. They're running private universities, and it's trading at 4 times earnings and 9% dividend yield. We thought it was cheap at 5 times earnings, and at 6 times earnings here, 4 times earnings is even cheaper. We don't know if the Hong Kong market will turn around in the next couple of weeks, but I think if you take a 1-2 year perspective, I mean, clearly if you can get exposure at these type of valuation level, that's interesting. And finally, if we turn to the US, so in the US, you typically had some of the more kind of tech-oriented companies being listed, and here we find some maybe slightly more risky companies, but we can really find, you know, a fintech company, for example, we just added to the portfolio as well at 1.5-2 times earnings. So China is intriguing, I would say. It's difficult, but I also think that there are great opportunities. Another example is Tesla versus BYD. So in the fourth quarter, BYD overtook Tesla as the world's largest EV producer, selling 500,000 cars. But they also have plug-in hybrids, which is equal the amount of EV. So de facto, they are selling double the amount of sort of electric vehicles compared to Tesla. Tesla is a great company with high margins, high return on equity, but the return on equity for BYD is actually higher. They have 24% return on equity, and they are growing their earnings at 31% versus 23% for Tesla. And that's at a multiple of 14 times earnings for this year versus and 11 for next year versus Tesla at 55 times earnings, right? So you do have a lot of these kind of interesting companies that I think over time they will simply revalue. Yeah, and with that, I hand it back to David, who will speak about some of the other large emerging markets.
Sure, yeah, thanks, Jacob. And I think one of the really major narratives over the last few years in the emerging markets complex has been the drastic shift in country weights in the MSCI emerging markets benchmark, which is the one that we and most other asset managers use. And you can see here that the weight of China fell from 44% in 2020 to 26% now. Whereas India, on the other hand, has grown from 8% in 2020 to 18% in 2023. Well, 2024, I should say, the current weight. And these are really, really significant changes. And we actually think the India weight will continue to grow. I think I very much wouldn't be surprised by the end of the year to see India at over 20%, or maybe a fair bit above that, depending on obviously relative country performance. And I think that the reason is very clear, really. If you look onto the next slide, you can see some of the sort of the key indicators. You know, they have a population that's unofficially already bigger than China, a median age of 29 compared to 38, 39 in China and US, 44 in the EU. Very low GDP per capita and incredibly strong GDP growth. So when you combine that with sort of benign or basically no geopolitical issues, companies wanting to relocate their supply chains into India, so to have a sort of China plus one policy, I think it clearly remains quite exciting. But I think as investors, what we're really interested in, and something we see consistently when looking at our portfolio companies, is it's not so much the sort of average income. It's really something that we call the acceleration phenomenon, and you can see this in slide 14. And essentially how this works is if you assume a sort of normal distribution of income, if average income rises just 25%, actually the share of the population that have incomes over this sort of 15,000 sort of entering middle class jumps nearly 7 times, which is an enormous increase. And that is exactly the type of consumer that we're targeting. You know, that's the consumer that will start ordering more food online, using a lot more banking services. And one of the really interesting examples we like is healthcare. And where, for example, India has half as many hospital beds as US, less than a third of doctors that Brazil has. However, what we see in India, as probably you're aware, that actually the very big healthcare names are incredibly expensive. Actually, the sort of the large cap healthcare names that everyone knows. So actually, as an example of how we invest, we like to invest through the largest pediatrics, so sort of mother and child care clinics in the country. This is a bit of a smaller company, bit off the radar of most investors, but actually has comparable growth, higher margins than the large peers, but it's a 20-30% discount just because it's that bit smaller, that bit less sort of well known. So that's an example, and it's been generating actually very nice alpha for us even in this year alone. But yeah, I'd then like to turn to Latin America, which is another region that we're very excited about. And here it's pretty simple actually. It's a story that Latin America has the highest real rates in the world, and real rates are the sort of central bank key rate minus the inflation rate. And so when the Fed does start cutting, actually there's enormous room in Latin America for these for these rates to start falling. And this is not just a sort of theoretical idea in the sense that our discount rates will fall, but actually these higher rates are having a very real impact on the sort of mid-cap growth companies that we typically like to invest into. And the example that I show here in this slide is Oncas Clínicas, which is Brazil's leading cancer clinic. And over the last few years, interest costs have represented almost 50% of their EBITDA. And that really limits their ability to invest and to grow. And despite the fact they have a lot of really appealing opportunities, actually. But what we'll see, Brazil has already managed to start cutting rates by 100 basis points. And so already this year, you're going to see interest costs falling as a proportion of EBITDA. And that will result in very significant earnings growth, as you can see on this slide, above 100%. And also the price earnings ratio falling from 31 times, which obviously seems quite expensive, to 16 times, which we think is very, very reasonable for such a dominant player in the market. But yeah, Jacob, maybe you want to discuss Eastern Europe now.
Yeah, thanks, David. So Eastern Europe had a rough 2022, as we all know, I think going into 2023, we just didn't really know what to expect. But I think there has been a remarkable recovery. So some of the Eastern European markets, they were actually the best in the world. I don't think we probably would have guessed that in the beginning of last year, but that's how it turned out. Poland and Greece were up around 50% each. Actually, if you look on our fund here, our New Europe fund, which is the exposure excluding Russia to Eastern Europe, the fund was up 43% with a 14% alpha. That's quite remarkable. It's quite spectacular. But I think without going into too much details, in Poland, we have now a new EU-friendly government. We are getting the EU budget and money at 2-3% of GDP into Poland. That clearly will help economic growth. In Turkey, we'll have finally the central bank sort of stabilizing inflation and the currency, and have increased interest rates above 40%. We'll probably see the last hike even today. So anyway, it looks pretty interesting. It's a small region in the big scope of things, but I think that we are certainly on the right track here. What can we expect for emerging markets in general? Well, I don't think we can expect any super quick performance. I mean, we still have some question marks, clearly, right? But I think to expect performance in line with earnings growth is probably reasonable. We'll have 18% of earnings growth for emerging markets this year. We'll probably have a little bit more positive sentiment to China because it's simply so bad now. And finally, from my side, what can happen when things turn around? Well, it moves very, very quickly. During the reopening trade in China, the market went up 60% during 3 months' time. That's how quickly the market can move. Again, now we have been moving in the other direction. It has been going down. But I do think that once we see the geopolitical tensions and risks somewhat coming down, the market certainly can perform.
Yeah, well, thank you, Jacob, and thank you everyone for joining us. And just like to say that we'll hope you'll join us for our fourth and final seminar, which is on Nordic corporate bonds. It will take place on the 25th of January. Thank you very much.